Tyler, let's talk about stocks we bought this year. January's coming to a close. Let's talk about some stocks that we bought and why.
Yeah, of all the people that I'm probably not the most optimistic investor, I'm pretty conservative. And yet, even in a market that's at an all-time high, I'm finding things worth buying.
There's always something out there to buy, depending on what your goals are and what you're looking to do. There is something for everybody to buy in the market almost all of the time. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. You see it right on the screen. It's fool.com/unscripted. The Motley Fool's got its 10 best stocks to buy right now for you. They're going to give that to you for free. Check out that link after this video. You could do it right now. Me and Tyler, we're not going anywhere. We'll wait for you to come back. So either way, check it out. More great stock ideas from the Motley Fool for free. Okay, Tyler, so let's go with yours first. Here's the two stocks we're going to talk about. We're going to talk about Easterly Government Properties. The ticker is DEA, one of my favorite tickers out there. I'm going to talk about Realty Income, but you go first.
Yeah, so I want to stipulate first because sometimes you have to buy for your goals, right? And I should make it clear, I actually didn't buy this for myself. This was a purchase I made because I manage an account for a retiree. And part of doing that, I have been looking for high yielding income stocks that I have a reasonable amount of confidence that dividend is going to be maintained for quite some time. And that is why I landed on Easterly Government Properties, because I think it's a reasonably paying dividend, albeit a constant one today. I think the market is
constant, meaning that their recent track record of their dividend payment is maintaining it, not growing the payout.
However, at the time of purchase, which I think when I made it, the yield was above 9%, which is well above what you'd get from something like a money market today. That provided me an opportunity to get a high yield investment that's going to provide some good income. And I didn't think, based on my assessment, that there was a severe risk of a dividend cut that could lead to a permanent loss of capital.
Yeah, I like that. And I've got it up on the screen right now. This is the yield over the past year. And you can see there was definitely a period of time where the yield shot up as the stock price fell late last year. And it's still consistently above where it's been over the past year. I want to spend a second talking about that. I made a video that I ran last weekend talking about CocaCola, how it's become so synonymous with Warren Buffett, who's synonymous with being a market-beating investor, and yet maybe the consumer brand company that's most associated with him hasn't been a great investment in the time that Berkshire's owned it. It's underperformed the S&P by a pretty wide margin, despite having all the very Buffett traits that we like. But for somebody with a specific goal that's looking to preserve value, generate an acceptable level of return, but maybe their North Star isn't necessarily beating the market, but they want to do better than other asset classes. Like you talked about, you want a yield that's going to be better than you can get from cash, for example, or even better than you can get from like treasuries and that sorts of things. Coca-Cola had been a great investment over the past 25 years based on that. So I think that's exactly where Easterly comes into play. All right, let's talk about Easterly, the business. I'm going to bring up a couple of slides here.
Easterly Government Properties, as the name sort of insinuates, leases buildings to the United States government, mostly federal. That, as you say, the ticker DEA, because a lot of what they did for quite some time was lease out to the Drug Enforcement Agency, and that was how they got their start. But now they have branched out a bit, so that not only is it DEA, but it's FBI field offices, VA outpatient hospitals, as some CDC assets as well. But almost all of them are federal government agencies. And this is what, to me, makes it attractive in terms of having a reasonable assessment that it's going to continue to pay its dividend. It's going to continue to exist as a business for a long time because it has the U.S. government.
One of the reasons you buy defense stocks is you have two things. You have a customer that tells you how much they're gonna spend years in advance. And oh, by the way, it's the United States government. You're pretty sure their money's going to be good.
When you have that sort of embedded advantage, something I've mentioned before with real estate investment trusts is counterparty credit risk. If you're the person that you're leasing to breaks their lease all of a sudden or can't pay their rent, if you're running a pretty thin cash or low margin business like real estate can be, that can be pretty detrimental to you. But when it comes to U.S. government, your counterparty credit risk is quite good. And so it allows the business to probably take on a little bit more leverage than other REITs. And at the same time, like you said, very deliberate, planned government properties, investments that go out years in advance. You don't see a lot of empire building that you see with other REITs where it's like, we're just going to keep acquiring properties regardless of the returns. It doesn't really happen in this business. And so as a result, I think what I have here is a business that is going to pay that dividend, barring some disastrous thing related to the U.S. government, which I can't really foresee that happening in any time
And if it
today.
does, you have bigger
Yeah,
concerns
much bigger
than
problems
addition of
than
your
my
top portfolio.
exactly. So with that in mind, with a yield that it was presented, I thought the market was a little bit overreacting to its leverage, and I thought it was a good opportunity to strike based on the needs of what I was trying to get.
There you go. And again, this is taking a look. It's been early 2021 was the last time Eastleigh raised its dividend. And future raises are probably not necessarily in the offings as they deal with their balance sheet and progressing with the modest amount of growth opportunities that they do have. But again, capturing even today that almost 8.5% yield, if your North Star is not necessarily beating the market, but you want an attractive yield and you can hold for the longer term to preserve your wealth through the volatility of the stock price, I think there's something there. I think it is. And Tyler, the fact that you're willing to, for a managed account for somebody else whose assets that you manage, that you see that opportunity, to me, that's a reassuring factor. I'm going to go in a similar direction, but with a different company and one where I think growth is still very much on the table, but we're going to stay in real estate, and that's Realty Income. I mentioned that kind of at the offing. I'm going to bring up a slide from its presentation, and this has become a bit of a go-to slide to me when I talk about Realty Income because it's a breakdown of how large it is and its core business. So Realty Income is in the net lease business, triple net lease. The customers, they pay a lease amount. Then they're also responsible for taxes, property taxes on the real estate they're leasing and maintenance and improvements to the property itself. They basically cover everything, and Realty Income generates a pretty meaningful profit on it over time. And it's important because a lot of their customers are in retail or in some other customer facing business, and there's concerns about the economy and the e-commerce and that sort of thing. And you see this pie chart they have, they show that a substantial amount of their rents, they say, are resilient to economic downturns and relatively isolated from e-commerce pressures, like things like restaurants and experiential businesses. You don't have a lot of concern from e-commerce there. I also want to just quickly break down the market size. It is a massive market. The US market, it's $4 trillion. They have stepped over the pond a little bit, but the vast majority of their business is still US based. The key is that there is a substantial amount of market opportunity here. What I'm not going to show in the slides, but I want to talk about briefly, Tyler, is how the business has continued to grow because of a couple of really important things. As Realty Income has gained scale because they're really good acquirers, they're really good at buying, they're really good at originating deals, and then leasing those properties. They have a long list of tenants, have real estate they own that don't want to own real estate anymore, and they do sale leaseback agreements. So they steadily acquire that real estate from their existing tenants and then lease it back to them. They've also recently acquired Spirit Realty Capital, which was one of their larger publicly traded competitors. Now they're integrating that business in. They're just really good buyers. They've been really good at that. But they've also started leveraging the fact that they have money and they have access to money and they have access to cheap money because of the strength of their balance sheet and how safe and stable the business is. And it's viewed by lenders as a very low risk borrower. So because of that, they've been able to do things like make a $900 million investment to acquire a stake in the real estate that the Bellagio is located on. So they've started to expand a little bit into kind of tangential real estate markets that still share some similarities in terms of the core strengths of their existing business. They're experiential, they're more protected from e-commerce, maybe not as protected against economic downturns in terms of it affecting the businesses that are their tenants, but its tenants are still really high quality. So they have the ability to get through economic downturns unscathed. And that's important. We've also seen recently a joint venture with Digital Realty Trust. Digital Realty Trust is one of the largest players in the data center business. It's become a maturing industry in a lot of Digital Realty's core markets. And Digital Realty took on a substantial amount of leverage over the past decade. It's made it a little more challenging for them to get access to capital at rates that make sense for some of the deals they're trying to do. Enter Realty Income, which is a JV in a recent deal there. It's a small deal against the scale of both of those two companies, but it's a sign that Realty Income is trying to leverage its access to capital and partner with specialists and experts in other places where they think they can generate some return. So it'll be interesting to see how that progresses. And the stock hasn't done great from its prior highs. And I think that's created some opportunity to invest. So that's one of the reasons that I added to my position in mid-January. And it's one that I think I'll probably continue to add more to over the long term.